Well, ladies and gentlemen, I think let's get going. Thank you so much for joining us this morning. Great to see all of you on this cold morning. We've got two things to talk to you about today. Um, it looks like a short agenda, but there's a lot to talk through. So Ian's going to give us a sense of the lay of the land. Lots happening in the marketplace. Rand strengthened quite nicely over the last few days. The market is still running. AI is still driving that rubber band. Who knows how far it's going to stretch? But Ian will give us a few anecdotal insights, and then Mike is going to take us just through an update on the C2C global offerings, which I think is quite pertinent at this point in time. Um, Look, it should always be on the agenda for us when we do our planning for our clients. But I think with the Rand doing what it did over the last 2, 3 weeks, it just highlighted again, I think for many of us and for our clients, that risk of SA only exposure. So that's the two official items, and we'll have some time for questions at the end. As always, you're welcome to post your questions in the chat box as we go, and we'll try and answer them either as we go or at the end, or you're welcome to unmute and ask a question as well. So welcome, and on that note, Ian, I'm going to hand over to you.
Awesome. Thanks, Eddie. Morning, everyone. Good to be with you. Oh, you jumped over the quote there. All right. There's someone from the group put up a little Robert Kiyosaki quote. But yeah, financial freedom is mental, emotional, and educational process. Makes sense. Yeah, so I just saw this little stat that some of you might have seen. I just thought it was quite interesting. This is property rental prices for one-bedroom apartment in different cities, and from the most expensive down to the cheapest. I don't think we're the cheapest, but interesting that in dollar terms, Cape Town, about $650 for a one-bedroom apartment. Obviously, these are sort of average prices. I think it seems about reasonable, but just look at that, some crazy prices, and it's understandable. You're always going to have huge differences, but I think in many ways, from what I've seen anyway, in terms of property prices around the world, it has gone crazy in so many places. So huge differences there. It also maybe speaks to some extent just of the price of the currency. Okay, so yeah, as Adi said, we're going to try and look at a little bit of the lie of the land. But before we do that, I thought let's just recap on some of the messages that we have been going through from the beginning of the year. So in January, we put up two outlooks. The one was a more cautious outlook from BCA, which is the research house that we get data from. And the other was more of a bullish outlook from Alpine Macro, which is another research house that we have engaged with. They were a little bit more bullish and have been more bullish. And to their credit, they definitely have been a little bit more on par with where the markets are going. And their view is that disinflation is actually going to be happening a lot quicker, and markets had already bottomed in 2022. So far, they've been on the money. Our conclusion was to keep focusing on the long-term expected return from assets. So you get these bull and bear views. You can't be dissuaded either way too radically. In February, we looked at two main questions, and it was mostly around the price of SA assets and bonds. Have they become attractive, or at what price point do they become attractive? And then again, what is the level of the rand, the appropriate level of the currency, given all the risks? And we sort of concluded that SA assets do need a risk-on environment. They do need a China. They do need a global risk-on environment to really do their thing and produce the returns that we need. And another factor which has been weighing heavily on SA assets has been the higher interest rates around the world. In March, we looked at the Silicon Valley Bank debacle, and we ultimately said, look, yes, you can focus on the bad news, but actually, when it comes to markets, bad news is often good news, because markets try and look through this, and they were trying to look through this to try and look for, okay, are we reaching a sort of inflection point where maybe interest rates are peaking, and liquidity needs to come back into the system. So those were the first 3 months. And then April, we looked at bit more focus on companies. We said, look, macro is important. Inflation is a big headwind, but ultimately companies have this ability to figure this thing out. And generally speaking, they will grow ahead of inflation. Try and grow their earnings ahead of inflation. Not all companies can do this, but the winners will pop up. And the thinking there was focus on the companies, and we discussed two main types: cyclical and non-cyclical businesses. And then last month we looked at the USD as the world's reserve currency. Bit of a history there, and ultimately said, look, I think don't get overly concerned about the demise of the dollar, not yet anyway, nor the debt ceiling. And yeah, we've obviously seen the dollar stay relatively stable against its basket, and the debt ceiling issues largely behind us. There's still some things they need to take care of, and there's a lot always, but a lot of this was noise in the system. Okay, so I've got one slide, and then we're going to take it to a poll. What I've done here is just, we've consulted a little bit to, or George Britz, who many of you may know, does a little bit of analysis and on all the funds in the local front, and he's pulled out by doing a survey across a whole bunch of funds. What are the main issues, and he sort of color coded this from green to dark red. So green is good. Valuations pop up as an attractive attribute that we've got on the local markets and the local assets across a range of managers. And then there's obviously a bunch of concerns, and these are all the reds. And obviously you've got the electricity debacle, the infrastructure issues in SA. We've got the politics. We've got inflation concerns. So, you can list all these things. These factors are already so much in the price. But the two themes coming out is definitely valuation, and we'll look at that a little bit. And then to some extent the commodity cycle. Although I think different managers have different views on that. And I think we've seen a little bit of a turnover of the commodity cycle that has pulled back a bit. So I think on that note, are we going to run the poll? So yeah, the question that we want to run here is, from a currency perspective, where do you see the rand at the end of the year? So you guys can look at that little poll, it should pop up. Okay. All right. There's some results. Is that all the results? 26, 33 responses.
Got some serious bulls in the house here, Ian.
Yeah.
Adrian, we're a positive bunch, Johnny. We don't play around, eh?
Hey, I like that, Dino. That's good
great
to see, man.
Yeah. 2% blowout above 25. Okay. Is that it? 41. We should have a few more come in. 43. Flat to stronger.
Yeah, that seems to be the verdict.
Is that it? Flat to stronger. Okay, that's interesting. All right. Okay, great. Okay. All right. So, look, we've had these headwinds. This is a bit of research that we get from Avia Capital Markets, and this is some of their wording. I mean, and the latest report is, is it darkest before the dawn? And we've had 7-8 years now of just generally outflows from foreigners generally selling the bonds and equities, and this we know these stats. The commentary is, so much bad news appears to be priced into the assets, and is it actually even discounting a failed state scenario? So there's been a lot of outflows, and ultimately someone's got to pick up the slack. it's a little bit more accurate to be measured when we look at the bonds. So if we go to the next slide. This is on the bonds space. Effectively, there's always for every seller, there's got to be a buyer. And really what's happened on the bond space, as we know, the local South African bonds, is that it's really the banks and institutions such as balanced funds and to some extent pension funds have been picking up that slack and buying and investing into the bonds. And so you've got those two lines, the orange and the dark blue line, picking up steadily. And we know that we see this, the funds that we manage have allocated extensively to the bonds, given the fact that you're getting 11.5%, 12% interest rate returns from the government. And the banks have been picking this up. But it hasn't been plain sailing because those yields have been moving up steadily. So, what we do need is you ultimately want buyers to come in. And that so far it hasn't happened. But at some point, the prices get too cheap. And again, we're asking the same question as we did a few months back and at the beginning of the year. At what price point is too cheap? So if we look at the currency, this is the sort of third asset. I mean, if we look at the South African context, I mean, you've really got equities and you've got the bonds and you've got the currency, and they all sort of go in kilter. We've got a situation where so much bad news has been priced in. As I said at the start, I mean, the point is that you've got higher yields globally, and that's been putting pressure on the rand. You've got this the election risk coming up. The third point there, I think, is maybe been underestimated to some extent, and that's obviously the extent to which the prudential limits have been increased to the 45%. So much money is looking for a price point at which to move up to that 45% slowly but surely. So I've called it a little bit of leakage on any rand strength. So for a lot of funds that haven't been taking up to that or trying to get up to that 45%, they put their price points in it. And so when we see a bit of rand strength, it's an opportunity for money to go out. We've obviously had general outflows from EM across the world, and then a point which is always a factor for the currency and the trade is obviously the weaker trade on the commodities. So the PGM metals have come down a lot, coal has come down a lot. So this is obviously absolutely affects your exports. And then obviously the last bit of debacle that we had obviously was the alignment with Russia, and how we're trying to sort of work our way through that and sort of untangle a little bit and trying to finesse our way through that. But that clearly tipped it over the edge a little bit. So there's been a lot of issues. A lot is already in the price, no question about it. And again, it comes back to when you just look at. I mean, this is just the price chart, but if we look at on a purchasing power parity basis of the currency, it is weak. If you look at the dollar on its purchasing power, it's exceptionally expensive. So, these things are not necessarily one-way bet. That does get overblown, and then there's a degree to which it's got to come back to a degree of normalcy. We don't know what that level is, and we'll have to figure it out over time. So that's the currency. So yeah, this is another chart that came from Kevin Lings, and essentially, I think what you do need, and what any investment needs, is you need established and protected property rights. We need a stable legal framework, and ultimately we need a more pro-investment political landscape. And so you've got the private sector that has essentially been a little bit on strike, and that's that green chart there. It's this percentage of investment as a percentage of GDP. And that's been trending down. And so private sector will invest and is happy to invest when they get a proper return and when there's stability of that investment and a reasonable outcome as to getting a return on that and the return of their capital. And when that isn't the case, obviously there's a degree of non-investment. So we need a slightly better landscape. and that speaks to really the sustainability. So that's globally that's what investors are obviously looking for, and there has been a degree to which they voted with their feet, so to speak, and effectively voted with their money and moved off. So that's what we've got with respect to the SA.
Ian, if I may, just maybe a comment or a question on that slide. If I look at government's finances, yes, it can always borrow more, but they don't really have substantial capital. The guys with the capital is the private sector. I think the last number that was put up is like 1.5 trillion on their balance sheet. So government, for us to really turn the SA economy around, we need government to give private sector the confidence to really start partnering with them again and to unlock some of that balance sheet with direct fixed investment through these public-private partnerships.
Absolutely. I would, I would say that at face value, government doesn't also appear to have, but I mean, they do. There is money there, and there's always money. I would say there's always money. Local companies, global companies, and the government. There's always money for a proper investment. Money is always looking for opportunities. And so, in my mind, it comes back to the stability of the of some of those key points that I've listed there. If you there's a bit. It doesn't need. I don't think we need 5, 6, 7, 8% growth outlook for investors to actually want to come in. You just want a stable outlook and a stable legal framework and a stable degree of property rights. So, if any bit of undermining on that, and then money has unfortunately voted and said, look, we don't really want to invest. So I would go as far as to say there's no shortage of money around the world. So there's no shortage, both on the private sector, government sector, and private sector globally, and governments globally. So I don't think it takes much. But it just takes basic stuff. So we'll have to keep watching this. As investors, we have to keep looking at this and figuring out, is it moving? Have we reached the point where everyone said, look, it's enough's enough, we've actually got to figure out what it takes? Or is it just going to, keep, is there going to be a degree of undermining? We'll have to just keep watching. And the facts will just have to dictate where investors, how investors allocate. I think that's the only thing we can really do as investors. We, invest in money. Money will look for the right opportunity. If we look at the global front, which does also impact on the local, I think I pulled this quote out from Peter Lynch. I mean, he was a really great fund manager. He ran one of the biggest funds in the world at one point, Fidelity Magellan Fund. And he was really focused on companies, and he said, look, the strength of our economy, and obviously we're speaking to the US, is that it's dynamic and always adapting to changing conditions. And I think that's the thing. He looked through the economy and wasn't too concerned about the macro side. So maybe we get too focused on the macro and less focused on companies who've got the ability to figure things out. So a few things. I thought I'd put this one up, and it's basically saying, look, again, the market is always trying to anticipate the underlying economy. The economy there is that blue line. The market cycle is the orange line. So it's always looking ahead. Where we are now is obviously, for some time now, from an economic perspective, it's been, this sort of recession has been anticipated. It's almost said to be the most widely anticipated recession. The market is ultimately trying to look through that and has so far looked through that. Been a huge big rebound in asset prices, and maybe it's a little bit too much, but who knows? But so far the recession is not quite here yet globally, but the market has been off to a great start over the last 12 months. If we look at, again, Alpine Macro's points, and I think it's interesting. They say on the inflation story, and obviously we saw the US inflation come out yesterday at the 4% level. It has been stickier than expected, but they were less concerned about the fact that it's pointing to a recession. But the big thing that they make here, these three big points here, is that first of all, the current disinflation has actually been broad-based across a number of categories. Secondly, what's important, we've got a chart on that, is that actually so far the Fed increasing the interest rates has not really been the major driver of the inflation rate coming down to the 4% level, which we saw yesterday from the 8% level, because of the lag effect. So that's still going to come. All of the disinflation so far has been due to a lot of just general price issues. Sorry, and the third point there is the market's maybe unappreciating the fact that actually inflation can fall off a lot quicker than what we anticipate. So just the one chart that I thought was quite interesting is this one where they actually put up the inflation rate there in blue, and then it is a busy chart, and then the interest rate in red. And each time you've got a scenario where actually it takes a while, and 35 months, 40 months, 24 months. So on average, it's quite a long time, 27 months, before that high interest rate really starts to bite and starts to pull down the inflation rate. And so the inflation rate decline that we've seen at this point in time has not been due to higher interest rates, and that's still coming on its way. So their view is inflation can fall down a lot quicker. And we're seeing that today. We've got the US interest rates decision, and it's pretty much going to, all things being equal, they're not going to hike the rates today. And the market's obviously anticipated a lot of that already. And then the one thing, if we do have a situation where interest rates have peaked because inflation has peaked, then there's a bit more of a consensus. And that's local fund managers and the research that we're getting globally on government bonds. And government bonds are generally quite an attractive place to have money. And their view is, and I think it's correct, is that actually on the government bonds, it should be sitting at around 2.7%. They're trading at about 3.8% on the US 10-year and over 4% on the 20-year. And so in a situation where you've got a slowdown, when you've got a recession economy, that these bond yields should come down to, let's say, about the 2.7%. Remember, as bond yields come down, if you own those bonds, that's capital appreciation. We've had the inverse in South Africa. The bond yields are high, but they've been steadily going up, and that's why there's a degree to which money has been lost. There's a bit of a capital erosion, so to speak. The converse is here. If the yields come down from these 3.84% levels down to about the 2.5% level, we will benefit as investors into bonds, and that's what the market's looking for. At the same time, when you've got interest rates peaking and going down, it supports asset prices. So it's not all doom and gloom. It's actually there's a lot of positive news out there. Okay, so if we look at the US market, in so many ways it's anticipated. This is a chart just showing of the market on the S&P 500 has gone up 13% year to date, and the bulk of that has been 5-6 companies. It's been obviously, NVIDIA has been a big one there, but the contribution to that 13% has been Apple, Microsoft, NVIDIA, Alphabet, and Amazon, and Meta, which is the Facebook. So you got all these tech companies, Tesla as well. You add all those up, that's been by far the largest contribution. And then the rest of the market, all 495 of them has contributed 1.4% to give you the 13%. So there has been some concern that it's been exceptionally concentrated as a market, and that can be problematic if the market has only gone up on selected companies, and it has been the case. It's been the tech names, it's been the names which are obviously definitely affiliated to the AI. So there's a degree to which there's a bit of speculation, as it were, and that does carry risks. And I think we have to be aware of these type of risks. We've seen this before when things can get a little bit too exuberant, and there's a degree to which that is the case here. Some of these companies are pretty expensive, even on a forward basis. The Nvidia, we've seen that one has been a huge run up in price, given its outlook on the AI story. Okay, and then in summary, okay, so we've got attractive valuations across equities, bonds, currency on the SA front, but there are these headwinds, and I think the biggest headwind is the sustainability. Because is it just a trade scenario, or is this a long-term sustainable prices? The other factor which we haven't really discussed here, and there's a lot of discussion about this, but it does appear that China's growth is just a little bit more on the sluggish side. There's a lot of issues there. It obviously kicked off the year on a great start as it opened up the economy, but we've seen the commodity prices off. We've seen China. There's a lot of issues there, and as we've always said, SA needs a strong China. We need a strong commodity prices, and that's a bit of a headwind. On the global front, on global risk assets, i.e. shares, they're constantly trying to anticipate the end of this interest rate cycle. So far, they've gone ahead of this so-called looming recession. There is a degree to which a lot of these, especially the tech names, appear expensive. But who knows? Because if we've reached the peak of interest rates and inflation, and interest rates can start coming down at some point, we're not saying that yet. But that's what the markets are sort of trying to price in. There's a degree to which the lower interest rates can sustain higher valuations. And then on the global bond side, again, in a similar vein, when there's a little bit of a slowdown in the inflation front, the bonds can rally, and so that's a place that a lot of asset managers are looking at on the global bond space, local bonds, global bonds, and we're seeing that more and more in terms of the allocations. So I think it's very interesting, and these things play out over time. But I think we always have to be cognizant of the fact that, sometimes, in many ways, and we've seen this, we can't get too hung up on the sort of news, and much of the news that pops out is obviously doom and gloom and headline making stuff. We've got to keep looking through that, and the market does that. Ultimately, the market tries to look through all of this. So those are some points. Thanks, guys, and maybe some questions. But let's see. Otherwise, I'll hand back to you, Eddie.
Thank you, Ian, for the insights. Very interesting lay of the land at the moment. Guys, any questions for Ian before Mike takes over? Otherwise, we can have questions at the end. All good. Mike, over to you. Thank you.
Great. Yeah, good to see you guys, and hope you're all doing well. I guess Ian sort of had his poll earlier on where we see the rand at the end of the year, and I think it was 80-odd% see that's either the similar levels or stronger. And I guess in that environment, you typically find people not necessarily looking to add to their global investments. I think the reality is that when South Africans are investing globally, it is typically for sort of long-term periods. And I would argue that, and sort of I agree that we probably are going to sort of have relative strength in the rand, whether that means that we're staying level to the dollar, or whether we do actually strengthen through to the end of the year. Over the short term, yes, there's potentially positive trends behind the rand. But if we look 5 years, 10 years, 15, 20 years out, it's highly likely that the rand will be weaker versus the dollar, given the higher interest rates and inflation rates. And so for those clients that don't have offshore investments, who are looking to invest for the long term, I guess now is as good a time as any to start that journey and start building up their offshore portfolios. And so to start off with, we'll go through the Seek Global Fund, which obviously was launched at the end of 2016. Essentially, it should be your one-stop global solution. So for investors investing globally, this is I guess got a bit of everything that's needed, and we'll get through that. Just to start off, to show the performance, great long-term performance. So this is our seed global fund since inception, the end of 2016. As I said, top quartile versus this is a range of global peers. I think there's 300 odd peers in this category. The sort of shorter term, 3 years, has been a bit tough. Quality as investment style has struggled a bit post COVID. But again, over the more shorter term period, performance is a bit more pleasing again. So the sort of 2022 was quite a tough year, especially for quality, which feeds into the 3-year numbers, especially the first part of 2022. But over the past 12 months, they've started to reassert themselves. And again, within this fund, we've got a lot of levers to pull, and have been able to bring up the performance on a relative basis. So just to break the Seed Global Fund down, it is managed with a long-term strategic asset allocation, but I guess the key is that it's not limited to vanilla strategies. We combine a range of structures within one fund, dynamically manage it as and when opportunities arise. And over the past 5 years, we've increasingly used what I'd call non-vanilla strategies. So on the right here, we can see just breaking down the fund into kind of core, satellite, bespoke, and liquidity. We can see the sort of the weighting to core type strategies has reduced over time, and to satellites and bespoke strategies has increased. And I think this will differentiate this fund compared to a lot of our peers. So what do I talk about, or what do I mean when I say core? So core is our actively managed UCITS funds that we invest into, typically owner managed organizations. They have a clear focus. They have delivered long-term alpha, and here we can see just a breakdown of the managers. Lindsell Train being a big one, struggled over the past 3 years, but has been more resilient in sort of a slowing global economic environment, and has outperformed global equities, the index, since we've included it. Prescient China, we've been invested into this fund for nearly 9 years. Prescient's been in China for over 10 years, and we have outperformed the global equities with only 40% of the global equity downside. And that's because China, and specifically onshore China A shares, are very uncorrelated with global equity markets. So while the Chinese market does have strong up and down swings, it is uncorrelated with other markets, and therefore is a great diversifier for our portfolio. And currently valuations are looking very attractive in the space. And we have, since earlier this year, we have shifted our exposure back up to China. Fundsmith, versus a quality manager versus Lindsell Train, have a bit of a bigger tech focus, and because of that, struggled a bit in 2022 as the growth stocks came off. Have generated great long-term alpha, and since we included them in late 2016, have generated in excess of 3% alpha per annum, and have had a great start to this year. So we continue to hold them as a key strategy. When we get onto the bespoke section, we do have some more Fundsmith exposure, but in a slightly different structure. When we look at the satellites, so there it's we're talking about passive exposure via ETFs. Specific views can be implemented, and it comes in at very, very low cost. So this grouping of ETFs at the moment has a TR of less than 0.15%, so less than 15 basis points. So again, we can get these specific exposures rock bottom costs. Gold has done well over the short and long term. It's an important asset in the world where money printing is a default to any problem. We know obviously rates have gone up, and liquidity's been drained out the system at the moment. But we know that if there's any economic, geopolitical big issues, if more banks fail or the like, money will be printed, liquidity will be injected into the system, and in that environment, gold does very well with maintaining its purchasing power. We have exposure to two different US Treasury ETFs. We moved on weight to bonds, so via the Treasuries in early 2023. First time in the sort of 7 odd years that the Seed Global Fund's been around that we've been on weight to global bonds. As Ian mentioned, bonds are looking a lot more attractive now with yields around 4 odd %. Fair value is probably sitting in the high twos. So if we go into this global recession that Ian says that we've all been anticipating, and there's any equity market weakness, these bonds will will give us some nice protection and potentially some capital gains. When I look onto the bespoke component, so here we're looking at assets that are have uncorrelated return drivers, asymmetric payoff profiles, sometimes hard to access assets, and ultimately this component at around a quarter of the portfolio is a big differentiator for the Seed Global Fund. It's largely allocated to structured notes, but we also include investment trusts in this grouping. We specifically limit the weight and have lots of holdings to mitigate maturity and liquidity risk. Credit risk is taken on the structured notes, so we only make use of highly rated banks and ensure that there's a diversity in the underlying issuers. Just to go through some of the bigger holdings, so we have the CIBC Fundsmith Booster. So CIBC is the Canadian Imperial Bank of Commerce. It's a large bank and highly rated bank in Canada, a very conservative balance sheet. But this note gives us more exposure to Fundsmith. So on a see-through basis, we have around 15% exposure to Fundsmith equity. And this note gives us 150% upside of Fundsmith equity, and it protects capital if markets fall by up to 30%. So this is what I say about asymmetric payout profile. We like Fundsmith equity. We're happy to just get normal exposure there. But we are able to, by taking on a little bit of credit risk, able to structure a position where we get, in the event that Fundsmith goes up over a six-year period, which is a very high probability, we get Fundsmith returns times 1.5. So if it's up 50%, we'll get 75% from our holding. And in the case, the unlikely case that the markets fall by sort of 20 odd %, we'll still get our full capital back. So by putting something like this in, we do get that asymmetric payoff profile. The Goldman Sachs SRI Booster, sorry, this gives us 235% upside of the MSCI World Socially Responsible Index, and protects capital if markets fall by up to 30%. So again, a note giving us geared upside to market returns and capital protection if markets fall off. Scottish Mortgage, I'm sure most of you, or a lot of you are aware, it's a Bailey Gifford managed investment trust. It's got a super long-term track record, but struggled of late, especially as growth stocks have sold off. It's got access to permanent capital, and with it invest into private equity, and is able to do that because there's while investors can buy and sell the trust, there's no run on the underlying fund. So the managers have the permanent capital and can take these long-term views. And while they do have a component to private equity, these are typically very large private companies, much larger than often a lot of the public companies. We remain happy with their process and positioning, and within this portfolio, should, as Ian said, should the interest rates start flattening and coming off, we could see that growth starts doing well again. And then finally, just sort of the last note that we'll talk through is the Morgan Stanley FTSE Auto Call. So this note, it will give us a 9.35% dollar return per annum if the UK's FTSE 100 is up over a period of between 3 and 8 years. So again, we protected capital protection for if the market falls by over 30%, over 8 years. So again, highly unlikely the market's going to go down. If it does, we get some elements of capital protection. If the market is up, we get a nice almost 10% dollar return, which I think any equity type investor would be happy with. So we get equity like returns if the markets are even up a little bit, and if they're down, then we sort of have our capital protected. Finally, at the moment, a bigger component of the portfolio than has typically been the case is our area of liquidity. It's an area where we keep powder dry, and given the late stage in the economic cycle, we think it's prudent to retain some risk-free capital available for any opportunities. At the moment, the vast majority of it sitting in the BlackRock liquidity UCITS vehicle, sitting with a net yield of in excess of 5%. So given rates have been hiked aggressively, we're getting a very high rate of return. At the moment, it is now at least a positive real return, and we're happy to earn this rather than having to allocate to risky assets. And as mentioned, as and when opportunities arise, we'll look to reduce this and put into more productive assets. Just to kind of summarize the portfolio here, we've got our positioning versus our SAA, our strategic asset allocation. And while we do have a sort of more traditional strategic asset allocation around which we manage it, I hope I've shown you that this is a unique fund with access to some very exciting assets and isn't your typical global balanced or so-called 60-40 fund. So in summary, we are multi-managed, so we've got 8 different managers within this portfolio, multi-assets. We have 6 broad asset classes through building blocks and multi-asset strategies, multi-geography. So we've got exposure to developed and emerging markets through vehicles that either invest globally or in specific regions. We have multi-style investing. So within this portfolio, we've got exposure to quality, minimum vol, growth, quants, valuations process, and passive investment style. So a range of different styles with the portfolio. And then finally, multi-structure. So we invest into UCITS vehicles, ETFs, investment trusts, structured notes. We assess each investment on its merits and each structure on its merits. There are benefits of each of these structures, and where it makes sense, we'll make use of the different structures. So again, I think this is quite a unique portfolio, and as I said, should be a one-stop global solution, given that we aren't just one style or just have one manager. For local investors, just a reminder that this can be accessed through the feeder fund. So for investors that aren't able or willing or able to send their money into dollars, they can use their rands to invest in the feeder fund and ultimately get exposure to this pool of global assets. Now, I'll just briefly touch on the Seed Global Equity Fund here. This is for investors who have a longer term investment horizon and want pure equity exposure. So here we're looking to blend the best equity strategies. Looking at the performance side, we've used the carve out since the sort of equity carve out of the global fund since its launch, just to give an indication of the longer term performance, which has been quite good. Up to the launch of the Seed Global Equity Fund in November 2021, and then we've used the live performance since then. The allocation to growth, as I mentioned, Scottish Mortgage has detracted over the short to medium term, and quality has also struggled to a certain extent. But we remain confident that these styles and the specific managers that are implementing these strategies will continue to generate long-term outperformance. And just to remember, as this is a global equity fund, the fund will be a bit more volatile as we don't have the asset allocation lever. Whereas in the global fund, we are able to shift our asset allocation dynamically over time. But we remain very happy with all the building blocks over the long term. And then just to give you some idea of the underlying holdings, you can see that there's a large name overlap with the Seed Global Fund. The weights can and will differ, and there will be an extra couple names given the different risk profiles of the products. We like our core allocation to quality managers, so the Lindsell Train and Fundsmith. As with the global fund, the satellites give us exposure to certain markets and styles at a low cost. So within the global equity fund, we do have some exposure to the momentum strategy to again diversify our style exposure to a certain extent. And then we sit with around a third of the portfolio in what we'd call bespoke type strategies. These give us kind of asymmetric returns. As mentioned to you guys earlier, a lot of these strategies have some element of capital protection explicitly built in, and will give us some geared upside if the markets do end up. So very happy with this, and I think it is a key, or will be a key driver of this fund over the next few years. And obviously, we'll continue to look to include these kind of strategies as and when they become available. Then just in terms of the TER, we've worked very hard at sort of making sure that this fund is very competitive from a total expense side. So the TER of the global equity fund is 1.1%. The TER of the feeder fund is 1.21%. So that will come in line or potentially even lower than a lot of your single managers. So the likes of your Fundsmith or Lindsell Train, if you're accessing them directly, you can access them through our fund with a diversification of a lot of other strategies and our multi-manager layer of expertise, and still come out with a similar cost. We are working hard to get it onto the various platforms. As you guys are aware, some platforms it is a bit more tricky to try and get your funds on there, where they are looking to consolidate. But we are working hard, and we will obviously be in touch with you as and when this fund and the feeder fund become more available for investors.
Thank you, Mike. Just looking at the Seed Global Equity Fund and particularly to the hammering the quality shares have taken and the growth shares, I guess, through the interest rate hike cycle. I think if we believe that we're close or at the top of that interest rate hike cycle, potentially a great time if you are thinking of externalizing any clients' offshore long-term money to look at the Seed Global Equity Fund. I think very well positioned for an interest rate down cycle.
Yep.
And I think we should get some really good growth during that period. So perhaps a great entry point if you think of buying a good share at a low price. You also want to buy a good fund sometimes when it's posed for good performance.
Yeah, I think I agree with you there. We obviously understand, I guess, over the shorter term, given that the economies are slowing down, there might be a bit of pressure on equities in general. But as you said, I think these the quality managers and the Scottish Mortgage, the growth manager, have had I guess more than their fair share of that downside already. So should we have another slight down leg in equity markets, these strategies should protect a lot better. We do, as well, as I said, have exposure to the structured notes that have a bit more explicit capital protection built into them over the long term. And yeah, if we do move into environments of a slowing economy, we will see interest rates starting to be cut. And again, that will start to be a tailwind for a lot of the strategies within the portfolio. So yeah, I would agree with you that there's it has been a bit of a tougher period since inception. And we launched the fund pretty much at the top of the market in late 2021. So it has been a bit of a tough time, but is very much positioned for the current environment and over the next 5-10 years, which is what you should be looking for if you're wanting to invest in global equities.
Thank you, Mike. Guys, that brings us to the end of our session. We've got a couple of minutes left. If there's any questions, we're happy to take questions for either Ian or Mike. Tomo, you've got a question.
Yeah, I mean, I think you saw that the Alpine, the ESET research saying the risk of recession is less than what it was. I mean, we're still talking economic slowdown. Are you guys thinking that the US is going to slip past that, or is that still fairly certain?
No, I think Yeah, thanks, Tom. I think there's still general consensus that it will head into a recession, and that's the sort of information we're getting from sort of both of those macro outlooks. It's just a matter of, will it be then there's a recession. Will it be a deep recession or not? And again, can the market, and has the market, or will the market sort of look through that and past that? So, I mean, this recession has been, it's been on the cards for a long time. And I mean, all indicators do point that way. If we look at the information we're getting from BCA, they're saying, listen, they're a little bit more negative, in the outlook. If we look at their analysis, and they're saying the interest rate hikes, is really going to hurt a bit more. And so, as Mike said there, I think we need to be a little bit cautious to some extent, and that's why if you look at the allocation of our global fund, we're slightly lower than neutral, obviously, on the global equity allocation relative to our SAA. So a little bit more cautious, and then again, it's the type of businesses that we own. So, while we've got some of the growth stocks, it's a little bit more focused, obviously, on those sort of more consumer defensive type names, those quality names, which should help in more of a downturn.
Thanks, guys.
Any other questions, guys? If there's no others, I hope that all of your predictions on the rand comes true.
Yeah.
And that the naysayers were wrong. We'll know by the end of the year. And good luck for the rest of the week. And we look forward to seeing you guys on the 19th.